Thank you very much for joining us today for this educational and informational webinar. Topic of today's session will be the Employee Retention Tax Credit Program. Updates, maximizing your credit, and minimizing turnaround times. So this is something those of us here at MP have been working feverishly on over the last several months as the program was expanded to help additional businesses. We've had great success assisting many businesses, including those within your industry, realize sometimes thousands or tens of thousands of dollars in employee retention tax credits. So just want to make sure everyone here in the association had a proper understanding of the program, and that if it's something that they may be eligible for, that they are researching and determining their eligibility and hopefully taking advantage of these, what can often be very lucrative credits. Just a quick hit about us here at MP. We are a full-service human capital management, HR and payroll provider. Work with clients throughout the country, again, to help them with their human capital management, their payroll, and their HR advisement needs. And a quick hit about the association here, a nonprofit corporation dedicated to promoting quality service and management in the ground transportation industry. The member companies provide private ground transportation services throughout New England. They are key and leading members of the industry and adhere to the industry's highest standards. So a very proud partner of us here at MP. We enjoy working together for things such as today's session. So my name is Paul Carelis. I will be the presenter today. I am the Vice President of HR and Client Services over at MP. Been at MP for about 8 years now, and in the industry for quite a bit longer, working with businesses of all shapes and sizes to help them with their HR needs. So the things we hope to cover and accomplish today will be talking about eligibility for the Employee Retention Tax Program, and specifically how the programs differ between the 2020 ERTC and the 2021 ERTC. We'll review some key definitions to make sure we're all talking the same language here. We'll talk about IRS guidance, which has helped kind of clarify some of the burning questions that many businesses and frankly that we had that kind of had us at first holding off on doing any filing of these credits, just to make sure we were doing it the right way, because the initial guidelines were quite vague, but the IRS in pieces has provided further clarification, which has helped quite a bit. We'll review some frequently asked questions, some potential scenarios. We'll go over some of the key facts and figures, and then talk about how you may be able to take advantage of this program if you haven't already. If you do have any questions, feel free to use the Q&A feature here within Zoom. Be happy to try my darndest to answer any questions live. If there's something that stumps me, be happy to do the necessary research and get back to you. Okay, so how did the ERTC all come about? Well, first things first, the ERTC program was born out of the very first stimulus bill back in, I believe, April or May of last year. The reason why we weren't talking about it then, but we're talking about it now, is because at the time that it was originally passed, the regulations stated that businesses could either do a Paycheck Protection Program or a PPP loan, or do these employee retention tax credits. They could not do both. So the vast majority of businesses went the PPP route, did their PPP loans, and kind of forgot about this because they weren't eligible. That all changed with the second stimulus bill, known as the Taxpayer Certainty and Disaster Tax Relief Act of 2020. So this bill was passed at the very, very end of 2020, late December of last year. And among other things, and why it's relevant to today's discussion, is that it eliminated the disqualification of PPP borrowers from also participating in ERTC. So very significant. What this bill did was say that you can take advantage of both programs, provided that you don't try to claim retention credits on wages that you paid for with PPP dollars. So that makes things a little bit tricky in the calculations, but something that we're familiar with and know how to work around. But it is important to note that while you are seemingly eligible for both programs if you meet the other requirements, and you can take advantage of both, you just have to make sure you don't double dip, so to speak. But among the other things that this stimulus bill provided was it created a program for the first 2 quarters of this year. The previous bill only did ERTC for 2020. Also expanded the eligibility in a couple of key ways. And then it also made advance payments available, which is kind of a moot point at this stage, but we'll get into that in a little bit. So this program opened it up for PPP borrowers and also opened up the program with some different rules and more lenient rules for 2021, first and second quarter. Fast forward to the middle of this year, President Biden passed the American Rescue Plan Act, or ARPA, I believe in April of this year. And that also had some significance when it came to how the ERTC program would work. So in addition to having the program for quarter 1 and quarter 2 of this year, ARPA also extended the program into Q3 and Q4. Now it is very important to note all of the slides that you'll see today, I left them untouched based on what's factual as of today, that being September 29th. The infrastructure bill that you've probably heard about that's being debated in Congress as we speak does currently have a provision in it that would cancel ERTC for Q4. So this doesn't affect being able to retroactively claim the credits for 2020 or the first 3 quarters of this year should you be eligible, but it would prevent any claims of ERTC credits for any wages paid in Q4 of this year. So as of right now, it's looking somewhat likely that will be on the chopping block, but there is still a lot of negotiating going on within the infrastructure bill and several other pieces of legislative action that could tip the scales one way or the other. So again, as of today, the waning days of Q3, Q4 ERTC is still in place, but there is a fairly good likelihood that it will be canceled. That said, the American Rescue Plan Act did also create what's called the severely distressed category. So this allows businesses who are in Q3 and Q4 of this year still suffering from a 90% or greater drop in revenues as compared to 2019, some additional credit opportunities to obtain more credit, even if they're considered a large employer. Not too many of those, but there are several that fall into this category of recovery startup businesses. So a recovery startup business is defined as a business who started February 15th of last year or later and has less than $1 million in annualized revenues. Those businesses, without otherwise being eligible, are able to claim an ERTC credit in Q3 and Q4 of this year. As of the way the infrastructure bill is currently written, even if they get rid of Q4 ERTC for most businesses, the recovery startup businesses will still have that available to them. Again, that is subject to change. That's the latest and greatest as of right now. ARPA did also give the IRS a 5-year statute of limitations to review, audit, what have you, any ERTC submissions. So you do want to make sure that if you file for employee retention tax credits, that you keep all of your substantiation and other documents on file for at least 5 years. The bill also did clarify that some other popular federal grant programs, at least when used for purposes of funding payroll, would be wages that would be excluded from ERTC, most commonly Restaurant Revitalization Grant and the Shuttered Venue Grant. For those of you who have used COVID sick pay, whether it be FFCRA leave or ARPA COVID sick leave, those wages would be excluded from ERTC as well. Okay. In terms of IRS guidance, it's come in bits and pieces. Bits might not be the right word because a lot of times it's in a 100-page or 200-page document. But for all intents and purposes, as it hasn't always been as timely as we had hoped, like many things with the IRS in this program, they have provided some solid information and some good examples to give us fairly good clarity about when something may be eligible or not. So the IRS has provided quite a bit of clear guidance on what qualifies as a suspension of operations. So we'll go into the eligibility in a moment, but one of the pathways to eligibility is if your business suffered a suspension of operations. And what that really is when a governmental order, whether it be federal, state, or local, causes you to suspend your operations or have more than a nominal effect on your operations. So you'll see the bullet here, the 10% rule. What that's in there for is because the IRS has defined more than nominal when we're determining whether a suspension of operations was more than nominal is if it has more than a 10% impact on revenues or staffing. So to give you a better idea, and certainly we can talk offline if there are any specifics to your industry or your organization, but to use some more kind of black and white examples, we work with a lot of breweries here at MP. So we have some who do both, takeout sales. They sell 6-packs or growlers, what have you, and then also have a tap room where people could come to the bar and sample beer or have some of the brewery's beverages. And in some cases, the takeout business more than made up for the loss of the tap room. So they don't qualify based on loss of gross receipts, which we'll talk about later. But because the suspension of operations being that government regulations prevented for a time for this brewery's customers to be able to sit at the bar and they couldn't serve customers drinks within the establishment, and that accounted for more than 10% of their business, even though the takeout sales more than made up for it, that counts as a suspension of operations. Similarly, in the restaurant industry, when restaurants were forced to limit the amount of dine-in customers or the percentage of dine-in customers they could have, that also counted. For an example of something that the IRS has said doesn't count, when we look at a retail, let's say a grocery store that was considered an essential business and allowed to remain open, they did have limits on the amount of people that could be in the store at a time. But the IRS has gone on record in stating that if the effect on the business is that people had to wait for a short time outside of the store until the safe number of customers was reached, then that does not count as a suspension of operations. So again, there is still quite a bit of gray area within the guidance, but we do at least have a framework and several scenarios to work off of. The IRS did also clarify how to go about claiming the credits. So those are most commonly done on a Form 941. When claiming it for prior quarters, it has to be applied to when the wages were paid. So essentially, we're filing a 941X or an amended 941 because the ERTC is a credit on employer Social Security tax. It is a refundable credit, so oftentimes the amount of the credit will exceed what was actually paid in Social Security tax, but where it is refundable, the business will get a check for the true amount of the credit. There have also been a lot of questions about eligibility for owners. So the current rule and the IRS guidance on the rule is that owners who own that own 51% or more of a business are excluded, and their family members are also excluded from eligibility. But if you have 2 friends who each own 50% or 3 friends who each own a third, those owner wages can be included. If it's a husband and wife or relatives that own half and half, then those generally have to be excluded because those ownership stakes have to be combined. But for folks who own less than 51% of a business, those wages can be counted if you're a 51% owner or greater, or a relative of such, you're excluded. There are also aggregation rules. So when there is a controlled ownership group, so let's say you own a few different companies, and for IRS purposes is considered a control group. For purposes of counting your employees and all of that, you do have to count those all together or aggregated. The nice thing about the aggregation rules is when it comes to the suspension of operations. So if you are a control group, while you have to aggregate your employee counts and your revenues and all of that fun stuff, if one of your locations or one of your businesses is subject to a sufficient governmental order that qualifies as suspension of operations, you can apply that across the entire organization and qualify the entire business based on that. They did also clarify that in order for something to be considered governmental orders when it comes to that suspension of operations, that it does have to be something formal, a mandate from a governor, a law that was passed, a clear directive from a government agency. It can't be something that, a recommendation, let's say, that was mentioned during a press conference or something like that. So, to further solidify the eligibility requirements, again, the formal definition of the suspension is operations that were fully or partially suspended during any calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID-19. Or, so it's either or, you don't have to meet both, experience a significant decline in gross receipts during the calendar quarter. So when we talk about sufficient decline in gross receipts, as well as some other things, again, the programs really differ from 2020 to 2021. So first, let's talk about the receipts decline. So regardless of which year you're trying to claim credits in, you're always comparing against 2019. That's always the measure that you want to use. So to be eligible for employee retention tax credits in 2020, when comparing same quarters against 2019, you have, if you don't meet the suspension of operations and you're looking to be eligible by receipts decline, that decline has to be at least 50%. When you're looking to qualify in 2021, the decline in receipts against 2019 only has to be 20%. And the 2021 program also has what's known as the preceding quarter rule. So let's say you're trying to qualify for this quarter run right now, quarter 3, based on receipts decline. You basically have 2 quarters that you're allowed to look at. You can either look at quarter 3 gross receipts and compare those to quarter 3 of 2019, or you can use the preceding quarter rule and look at quarter 2 of this year against quarter 2 of 2019. So essentially, if in 2021, if you qualify because of gross receipts in a given quarter, you automatically qualify for the following quarter as well, even if your revenues shoot up dramatically. The amount of the credit also differs depending on which year's program you're looking at. So the wage-based limit is always $10,000. So you can never claim the credit on more than $10,000 in any employee's wages. But the amount of the credit in 2020 is 50%, or up to $5,000 per employee, versus in 2021, the maximum credit is 70%. So you can theoretically get up to $7,000 per employee. The other important differentiator is that the 2020 program is kind of all quarters combined. The 2021 program is really 3 programs or 4 programs, depending on the fate of fourth quarter, in one. So in 2020, you're looking at all the quarters together and claiming no more than $5,000 per employee for the entire year. In 2021, that script gets flipped, and you can look at each quarter individually. So if an employee has $10,000 in wages within a quarter, let's say quarter 1, you can get a $7,000 retention credit in that quarter. If they then have $10,000 in wages in quarter 2, another 7. So should fourth quarter stay on the books, you could be looking at up to $28,000 in employee retention credits for a $40,000 or more year employee. In terms of the time periods when you can be looking at wages and claiming the credit, for 2020, the first date is March 13th through the end of the year. And for 2021, it's January 1st through either tomorrow, September 30th, or December 31st, depending on what happens in Congress. All right, so for some key definitions, again, the wage period is March 13th through either the end of this quarter or the end of this year. Qualified wages are considered salaries, commissions, tips, or any other similar compensation that would be subject to FICA tax, or wages that are subject to Social Security and Medicare taxes. And then when you're calculating gross receipts to see if you had a sufficient decline to be eligible, you include all total sales and all amounts received for services, including interest, dividends, rents, royalties, and annuities. So it's really the kind of the top line number. You don't factor in, the expense of doing business or supplies or anything like that. It's truly gross receipts. So to talk about that a little bit further, the way that this works is if you're looking to qualify in 2020 based on gross receipts, you look for the first quarter in 2020 where your gross receipts dipped by more than 50% when compared to that same quarter in 2019. You continue to be eligible until you have a quarter where the decline was less than 20%. You still would qualify in that quarter where the revenues rose to above a 20% drop. It would just be the calendar quarter following that you would then lose eligibility. So in this scenario here, where let's say a company dropped 52% in quarter 2, they would qualify there. In quarter 3, their revenues picked right back up and they were only down 17%. They would still qualify and be able to claim in that quarter, but in the following quarter, because their revenues rose and were less than a 20% drop, they know they would not qualify in Q4 of 2020. All right, so let's talk about some frequently asked questions. Again, we've been working with many businesses on this program, and there are a lot of questions that businesses understandably have. This is a brand new program, and oftentimes even accountants aren't quite familiar with it. The timing of it was very tough on them. This all passed again at the very end of December last year, so they were up to their eyeballs in year-end taxes and all of that stuff. So this caught them off guard. It caught the IRS off guard. There have certainly been some messy, excuse me, some messy aspects to this, no doubt. So, I think the burning question is that we get from clients that we worked with is, how long is it going to take me to get this money? And unfortunately, it's generally a long wait, especially if you are claiming for 2020 or the first 2 quarters of this year, because the claim that you're making is going to be on an amended return, and the IRS does not currently allow amended returns to be filed for at least Amendment 941s to be filed electronically. They have to be done on paper. So as you can imagine, this program has been pretty popular, and the IRS is just absolutely inundated with returns and trying to get through those. They originally only had one office dedicated to processing these. They have made some improvements, but once the employee retention tax credit is realized and filed, a business can reasonably expect to wait anywhere from 4 to 7 months before they have a check in hand from the IRS, unfortunately. They are working to improve that. We have seen more on the side lately of 4 months rather than 7, but they are still backed up quite a bit. The best piece of advice I could give is, if you do indeed determine that you're eligible in 3rd quarter, you want to work with your payroll provider, whether that be us or anyone else, to make sure that, if you can, you get your credit amount on your quarter 3 941, so the regular 941 that your payroll company would be filing anyway, because that will greatly speed up the process and the time of you getting your check. So again, an amended return could take anywhere from 4 to 7 months for you to get paid on. If you can get it on your 941 within the next week or two, you'd probably be more likely looking at 6 to 8 weeks before you have a check in hand. So obviously a much faster process. Because those are e-filed, they don't have to go through the amendments department at the IRS. It's just a much faster process. Here's another question that comes up. Does an employer need to prove that a significant decline in gross receipts is related to COVID-19? So a lot of businesses can have various disruptors or various reasons why they would have a dramatic decline in sales. So the answer to this is no. Within the legislation, there's no requirement that or any need to explain why there was a decline in gross receipts. So it does not necessarily have to be related to COVID-19. Okay, so something I didn't touch on too heavily in the chart that I referenced earlier was large employer versus small employer. So maybe I'll quickly go back to that. So you'll see here the definition of large employer varies from 2020 to 2021. And this is significant because if you are determined to be a large employer, it limits which wages you can count for ERTC purposes. So if you do fall under the large employer category, you'd be limited to claiming ERTC credits on wages and expenses paid to employees who weren't performing work. So what that most commonly is when employees were furloughed, if they received any type of payment during their furlough, or the cost of their health insurance would be able to be counted. In terms of how that employee count is determined and defined, again, you're looking at 2019, and you're only counting employees who worked 30 or more hours per week in 2019. You don't have to, it's not like the Affordable Care Act where you have to count 2 15-hour-a-week employees as one full-time equivalent. You don't have to worry about equivalents. You're just looking at actual full-time employees and what that number was in 2019. All right. So another question, what if the credit that's calculated exceeds my tax liabilities? This is a refundable and advanceable tax credit, so you will receive the full amount of the credit even if it's more than what you actually paid in Social Security tax. So we touched on this a bit earlier, but you can never hit it home enough. This is really one of the key aspects of the program. If more than a nominal portion of a business's operations are suspended by a governmental order, meaning more than 10% of a business's function. So again, if there is any question about that, feel free to reach out to us. We can talk through it together and hopefully help determine. Probably doesn't apply too much within this industry, but for others it has, where a business wasn't necessarily themselves fully or partially suspended because of government order, but if one of their raw supply channels was subject to shutdown or suspension of operations because of governmental order, that can count as well. So again, these figures are subject to change, but again, up to $5,000 per employee in 2020, up to $28,000 should fourth quarter program stay alive, and up to $33,000 in combined ERTC available per employee. So as I said, we've helped businesses in all various industries on this. I think we're up to about $20 million collectively in credits we've been able to help clients reach. But in terms of how to do this, again, at least how we do it, or how you'll want to go about doing it, or whomever you decide to work with for these should you determine that you're eligible. You want to gather up all of your payroll data, your gross receipts, any proof you may have of suspension of operations. It's also really important that you gather up and have a good handle on your PPP data if you did receive PPP loans. Because again, you do have to exclude those time periods where you use PPP for payroll purposes. Important to note, under the PPP program, you're required to spend at least 60% of the loan on payroll costs. Should you have other eligible expenses, those can account for up to 40%. And the more that you can do that, the more advantageous it'll be in terms of growing your employee retention tax credit. Because even if you say use the 24-week covered period for your PPP loan, if you used the payroll cost portion or spent it on payroll in less than 24 weeks, you don't have to exclude those entire 24 weeks from ERTC, only the actual wages that you paid with PPP funds. So a lot of times for many businesses, that'll be shorter than the 24 weeks. It might be 8 weeks or 12 weeks or even 20 weeks, but it does allow more time for retention credits to be realized. But once you've excluded that PPP, you want to do your calculations, and then again, these are realized by filing a 941 or an amended 941. So we do have decision trees available. We can make these available to the association that just kind of help you walk through your situation to determine whether or not your business or anyone you work with may be eligible for retention credits. So in terms of top 10 things to take away and to know, to feel like you have a good handle on this, first you want to understand those key differences between the 2020 and 2021 programs. You want to calculate your employer size and know what it means. You want to have a good understanding of your gross receipts for Q2 through Q4 of last year and all quarters of this year, as well as all quarters of 2019. You want to understand whether or not the impact that government regulations had on your business during the height of COVID would qualify as a suspension of operations. You want to understand whether or not you need to exclude any owners or family of owners from your calculations. You want to have a good understanding that you do need to aggregate multiple entities within a control group. You really want to understand how to maximize around your PPP loan. So again, if you have not yet filed for forgiveness, using up to 40% in other non-payroll expenses as part of your forgiveness application, and then making sure you're capturing time before and after your PPP loan to really maximize your credits. You do want to make sure you keep all your documents on file for at least 5 years. Understand that this isn't too good to be true. It's real, and companies are receiving some real money in the mail as a result of this. And then lastly, just some patience when it comes to the IRS stage. They are working on it, but it is taking an incredibly long time for them to process these. But what we do is we run IRS transcripts that hopefully track the status of a refund. It's just taking a while. All right, looks like we did have a question come in. Let me see here. If I qualify in Q2, but in Q3 revenue is higher than the 2019 numbers, can I still qualify? Yes. So if your qualification and your eligibility was based on the gross receipts decline for Q2, you're allowed to use what's known as the preceding quarter rule. So if your Q2 revenues were down by more than 20% when compared to Q2 of 2019, you do automatically qualify for Q3 as well, even if your revenues were up. Great question. In terms of other questions that have come up, it is important to make sure that, especially if during COVID you changed your business address or you moved or you closed your offices in favor of a home office, you do want to make sure that everything is filed and that the IRS has your most current legal address. The reason for that is that there is not an option for a direct deposit of the ERTC. It does have to come in the form of a paper check, and that is mailed to the address that they have on file. It seems like there are limits or restrictions on forwarding of these checks. So we did have an unfortunate incident or two where a business did move during the pandemic, and the IRS did not have that address change on file. And so when the check was mailed to them, it did get kicked back to the IRS. So the last thing you want to do is delay these payments any further. So do make sure, if you have moved, that the IRS does have your current address on file. That's important because these will be coming as a paper check. Generally, what we're seeing is that a letter is, at least for the amended ones, and a letter is coming in the mail advising them that they qualified and that they'll be getting a credit, and then a couple days after that, the check then follows. Okay, well, I thank everybody very much for their time. Should you have any questions for us, you can always reach us at hr@mp-hr.com. Happy to answer your questions on this or anything else. Again, we'll make sure we'll send out the decision tree to everyone. We'll send everyone who's part of the association here another link to our HR electronic HR hotline, where folks can submit questions via the web and get a response on any type of HR issues you may be experiencing. Great resource for the association here to help out with any sticky or compliance related questions you might have. But again, I thank you so much for your time and your partnership, and I hope you all are able to receive some big credits here. Thank you so much.